This is the recorded lecture, the first part for Chapter 3, Adjustments. So let's go ahead and get started. I'll share my screen with you. So the first thing that we're going to do is we'll look at the PowerPoint presentation. So here's my screen. Let's talk about what is in Chapter 4. I'm sorry, I keep saying Chapter 4, but Chapter 3. So far, what we have done in accounting is we have looked at accounts. We know where those accounts belong. We have learned the basic financial statements, and we spent a lot of time on properly debiting and crediting those accounts. So basically, look at the accounting period. We talked about how in accounting we prepare journal entries for transactions as they happen. So those transactions happen during the month, they happen during the quarter, they happen during a 6-month period, or they happen annually. So we know what to do with transactions. I like to call them original transactions as they occur. We know how to analyze them. We know how to determine whether those transactions matter or not. We know how to pick the affected accounts, and we know how to debit and credit those accounts. So we have learned how to deal with the original transactions during the accounting period. So the reason why we divide the company's life into those accounting periods is so we can provide timely information about how the company is doing during those regular intervals, during those regular periods. Just like our lives, the life of a company is divided into months, quarters, or years. We call this the time period assumption, and the time period assumption is very important because just like we learn how to deal with regular or original transactions that occur during the period, today we're going to learn how to deal with adjustments which happen at the end of the period. So companies prepare financial statements at the end of every period. Those financial statements are based on the original transactions that we learn how to deal with in Chapter 2. But in addition to those original transactions, companies also prepare adjusting journal entries, which ensure that revenues and expenses are reported in the correct period. So in accounting, we will be using the accrual basis of accounting, which basically states that revenues are recorded when products and services are delivered, and expenses are recorded when they are incurred or when they happen. The cash basis of accounting is not allowed for publicly traded corporations because their revenues are recorded when cash is received and expenses are recorded when cash is paid. So let's spend a little bit of time discussing the two very important principles in accounting. We call those principles the revenue recognition principle and the expense recognition principle. Again, we'll be using the accrual basis of accounting from now on. The cash basis of accounting is not allowed for publicly traded corporations because of the assumption that it's making that revenues are recorded only when cash is received and expenses are recorded only when cash is paid. So forward, we will focus on the accrual basis of accounting. So the two principles, I'll skip a couple of slides here, is the two principles are the revenue recognition principle and the expense recognition principle. So under the revenue recognition principle, we will assume that revenue is recognized when the goods are sold, when the services are provided to the customer, and not when the customer pays for those goods and services. Again, the revenue recognition principle states the revenues are recognized, those revenues are reported on the income statement as revenues when the services are provided and the goods are delivered or sold. You probably noticed that I'm emphasizing on the words delivered, sold, provided. Those words are in past tense. Again, in order for revenue to be recognized, the goods have to be sold or delivered and the services have to be provided. This is the basics. This is the foundation of the accrual basis in accounting, which is mandatory for publicly traded corporations. At the same time, as revenues are recognized, we need to be recognizing expenses as well. Those expenses are recognized when the expenses are incurred, not when the expenses are paid for. Remember, expenses go on the income statement. They're the cost of doing business. So regardless of when the company pays for those expenses, they are recognized when they happen and they are matched with the revenues they help generate. So those two principles, the revenue recognition and the expense recognition principle or the matching principle, are very important for Chapter 3, for publicly traded corporations, for the accrual basis of accounting. You probably heard me say it doesn't matter when the company pays for those costs, or it doesn't matter when the customer pays for the services the company provides. So we will be very much ignoring when the cash transaction happens. The focus of Chapter 3 is recognizing revenues when they are earned. Revenues are earned when services are performed and the goods are delivered, and recognizing expenses when those expenses are incurred. So again, we will be ignoring the cash part of the transaction. All right. So I'm going to go back to this slide. This is slide 5, the accrual basis versus the cash basis of accounting. When we were on this slide a few minutes ago, I mentioned that the accrual basis of accounting is mandatory for U.S. publicly traded corporations. The type of accounting that we're studying in this class, financial accounting and reporting, applies to U.S. publicly traded corporations. So cash basis of accounting is not allowed. However, if you have your own small business, let's say I had a small catering business, I can totally use the cash basis of accounting. I can recognize revenues when I collect cash from my customers, and I can recognize expenses when I pay for those expenses. But a small business is a small proprietorship. It's not a U.S. publicly traded corporation, so the cash basis of accounting is totally allowed. All right, so let's go to McGraw-Hill. So I am going to go to Blackboard. Then I'll click on the McGraw-Hill folder, and then that would take me to the McGraw-Hill section of this class. In Chapter 3, I'm going to select the in-class practice, and I'm going to work that as a student. So this is exactly how you guys are going to see the assignment. Remember, these assignments are not graded. This just helps you understand the material. This also helps you, follow along with me or practice more. So today, I'm going to start with problem number 1, which is QS 3-2 in your book. The first question that we will work on is a question that shows us how net income is different between the accrual and cash basis of accounting. This further solidifies your understanding of the fact that for publicly traded corporations, the cash basis of accounting is not allowed. We will be using only the accrual basis of accounting. So I want you guys to look at the problem, read through it, and let's work on this problem in just maybe 30 seconds to a minute. So I want you to understand what the data that you're given is. All right, so hopefully you had a chance to look at the problem. I'd like to read it along with you just so we know what information we're given. So in this case, we're given some information about the Roma company. Their earned revenues are $45,000. Out of the $40,000, 37,000 are received in cash from customers. They have incurred expenses of $25,000, and they paid $20,250. And then in addition to that, they prepaid $6,750 for costs that will not be expensed until year end. Our job is to show that the first year net income for the company differs under the cash and under the accrual basis of accounting. Again, this is a very good illustration of the point I made earlier. Cash and accrual basis of accounting are different, and cash basis of accounting is not allowed for U.S. publicly traded corporations. So let's look at the cash basis of accounting. Under the assumptions of the cash basis of accounting, we recognize revenues only when cash is received. So when I look at the first bullet point, earned revenues of $45,000, I know that under the cash basis of accounting, we will not be recognizing the full $45,000 amount because only $37,000 is collected in cash from the customer. So my revenues here would be $37,000. Under the accrual basis, though, earlier I mentioned that we will be completely disregarding the timing of the cash payment. I'm sorry, the cash receipt. So if the revenue is earned revenues are revenues where the company has delivered the product or provided the service. If the revenue is earned, regardless of how much of it is received in cash, we will recognize the full amount. So the accrual basis of accounting allows us to show earned revenues on the income statement and disregard the cash collection from customers. Let's look at the second bullet point. They incurred expenses of $25,500. Under the cash basis accounting, will only recognize $20,250 because this is how much the company has paid. And under the accrual basis of accounting, we will recognize the full $25,250 because the expenses have happened, they have been incurred, and we are ignoring the timing of the cash payment. I'm going to look at the last line here. They prepaid $6,750 cash for costs that will not be expensed until next year. Those costs are, if you remember from the last few weeks, those costs are prepaid expenses. They're assets. So under the accrual basis of accounting, we will not be including those costs at all. I'm ready now to calculate net income under the accrual basis of accounting, which is basically the difference between the revenues of $45,000 and the expenses of $25,250. So net income under the accrual basis of accounting is $19,750. I'm purposefully skipping the cash basis because of this last bullet point. If I look at cash basis, I included the $20,250 cash paid towards incurred expenses. But I'm going to have to change this number. I'm going to have to increase it because under the cash basis of accounting, I also have to account for the cash spent for the prepaid expenses. So instead of $20,250, I'm going to have to increase that number by the last bullet point of $6,750. So my expenses here would be $27,000, and net income will be the difference between the revenues of $37,000 and the expenses of $27,000, or $10,000. Now, I want you to look at that net income. Under the accrual basis of accounting, we report a higher net income because we include every single penny of revenues that are earned and every single penny of expenses that are incurred, which is not true for the cash basis of accounting. All right, do you guys have any questions? If you don't have any questions, yes, hold on. Someone has a question. Let me see. And the question is, where did the 27,000 come from? The 27,000 is the 25,000. If you look at my cursor, I'm highlighting where the 27,000 came from. You have $20,250 cash paid towards incurred expenses. I'm adding another 6,750 because under the cash basis of accounting, you will include every cash payment that the company has made towards expenses, regardless of the fact that those expenses in the last bullet point are actually prepaid. They are considered assets. Does that help? All right. Okay. So let's see if maybe there's another. Okay. Shouldn't the expenses under the accrual basis be 25.5? Not. Yes, that's something that I mistyped. Yes, 20. This one here is 25,500. You're correct. So can you guys recalculate the net income as well? It's 500. Okay, perfect. All right, so let me see. Let me remove this. There you go. Okay, let's go back to the PowerPoint presentation. The only thing that I really want you to know, I'm not going to ever ask you to calculate accrual versus cash basis of accounting on an exam. However, there's a problem on the homework that you have to recalculate. I think I'm getting some more questions. Let's see what those questions are about. Hold on. Revenues minus expenses. Yes, Janelle, that's correct. So I'm starting with the revenues and taking the expenses out. All right, so let's go back to the PowerPoint presentation. We already talked about recognizing revenues. Again, the terminology here that I want you to be familiar with is revenues are recognized when they are earned, and revenues are earned when the goods are sold, past tense, the product is delivered, past tense, and then when it comes to services, the services are performed or the goods are completed. We will not be using the cash basis of accounting for the purposes of this class because it is not allowed for publicly traded corporations. The accrual basis of accounting really is determined by this revenue recognition and on slide 9, the expense recognition principle. So the reason why these are important is because at the end of every month, every publicly traded corporation has to look at their expenses, they have to look at their revenues, and make sure those expenses or revenues are reported in the appropriate accounting period. So here's the framework for adjustments. There are 4 types of adjusting journal entries. And those 4 types are deferred expenses, deferred revenues, accrued expenses, and accrued revenues. So let me just change the wording a little bit and you'll know what I'm talking about. Deferred expenses are really prepaid expenses, which we studied in chapter 2. Deferred revenues are really unearned revenues, which we studied in chapter 2. These are the more difficult journal entries that we'll be dealing with in this chapter. Accrued expenses and accrued revenues really are just like the original journal entries that we learn how to prepare in chapter 2. So today we'll focus mostly on defining the type of adjustment. We'll talk about deferrals first. We'll probably spend most of the class period on Wednesday discussing deferrals because they are the more challenging of the adjustments. And then on Wednesday, we'll finish our discussion with accruals. But I'm really not that worried about accruals just because you know how to prepare original journal entries. Those 4 types of adjustments, at first, will follow the 3-step process. We'll determine what the current account balance equals. Then we'll compare that current account balance to what the account balance should equal. And we'll record the adjusting journal entry to make sure the current account balance is either increased or decreased to match what should be found in that account. All right, so let's look at deferrals of expenses or deferred expenses. Earlier, I said that deferred expenses are also called prepaid expenses. So let's talk about what prepaid expenses are. In Chapter 2, we discussed prepaid insurance, we discussed prepaid rent, prepaid advertising. Prepaid expenses really are assets. The company buys insurance ahead of time, or they buy an ad in the local paper ahead of time. The prepaid expense is an asset until it is used up. So what the original journal entry is the purchase of that asset. So the original journal entry will involve a decrease in the cash account. So when the company buys insurance for 12 months, their prepaid insurance will go up and their cash will go down. That would defer an actual expense until the company uses up insurance. Okay, so let's talk about the account titles. We know prepaid insurance, prepaid rent, prepaid advertising, supplies is also a prepaid expense, and so are the purchases of long-term assets. So we'll talk about that in a few minutes. When the company purchases a long-term asset, it stays on their balance sheet as an asset until it's used up. So we'll learn how to depreciate assets today. All right, so let's start with the actual original entry. So the prepaid expenses are assets. When the company buys prepaid insurance or prepaid rent, we have to debit that account. But look here, right here in the middle, when the company uses prepaid insurance or prepaid rent or supplies, we have to credit the asset account and decrease the outstanding balance. And we have to debit an actual expense account and report it on the income statement where it would consequently decrease profitability. So let's look at slide 13. Here's how it works. In this case, the company purchases $2,400 worth of insurance on December 1st. The $2,400 is to cover 24 months worth of insurance beginning on December 1st. So now the question is, what adjustments do we have to make to that account? So here, sorry about that. Here on December 1st, we can see the debit to the account. We have increased assets. All right, hold on a second. There is a question, I think. Whose birthday is it today? Janelle's. Well, happy birthday, Janelle, if it is your birthday. Okay, so the company purchases insurance. Oh, wait, maybe December 1st is your birthday. Is December 1st? Well, happy birthday on December 1st. So in this case, on Janelle's birthday, they purchased a 24-month insurance policy for 24 months. So now the question is, what should happen at the end of December? So at the end of December, the company has used up 1 month worth of insurance. So we need to recognize that at the end of December on 12/31, we have to reduce the prepaid insurance account and increase the insurance expense to show that the company incurred the cost of insurance for 1 month. And hey, Janelle, December 31st is my mom's birthday and also my brother-in-law's. So December is a good birthday month. So all all we have to do here is determine what is the monthly insurance expense. And the way we do that is by dividing the total amount of the policy, 2,400 divided by 24 months. So $100 a month is what the company will be consuming every month for the next 24 months. So in this case, on December 31st, we need to show a reduction of 1 month, and the ending balance in this account should be $2,300, which represents the unexpired portion of the insurance the company purchased. This credit here of $100 and the debit to insurance expense is what we're recognizing as an expense on the income statement to reduce profitability by. All right, so when we adjust those accounts, we will take away $100 from the balance sheet. The balance sheet now will show the correct amount of $2,300 in prepaid insurance, but it will also show the correct amount on the income statement, the $100 representing 1 month of expired insurance. So let me just pause here for a second and talk about the effect of this adjusting journal entry on the financial statements. You'll probably notice that this adjusting journal entry affects both the income statement and the balance sheet. It reduces a balance sheet account, but it also reduces profitability on the income statement because expenses just went up $100. Okay, so let's look at what the adjustment would look like, the actual journal entry. We will be working problems that require us to prepare journal entries on Wednesday. But for now, I just wanted to see what this looks like. So a deferred expense pushes the expense recognition into the future. Remember, the company purchased the insurance on December 1. The expense is deferred to December 31st. So a deferred expense is an adjustment where the cash transactions happened in the past, the expense recognition happened in the future. The journal entries for deferred expenses and deferred revenues and accrued expenses and accrued revenues will always happen at the end of the month. They will never affect the cash account. So in this case, on December 31st, we'll debit insurance expense and credit prepaid insurance to record the first month's expired insurance. All right, so very similarly, we can adjust for supplies usage. So hold on, let me look at the question asked. Why is the expense? Okay, so the question is, why is the expense credited if it's an added expense? So let me go back to the PowerPoint. The expense is debited, it's not credited. Expenses increase on the debit side. What's credited is the prepaid insurance, which is not an expense at all, it's an asset account. Does that make sense? Okay, if that answers your question, let me see if it does answer your question. Okay, I will continue with the next example. So here is another example of a deferred expense. Earlier we talked about the supplies are a prepaid expense. We purchase supplies today to use them in the future. And long-term assets are prepaid expense, so we'll do that after supplies. So here's an example here for supplies. Fast forward purchase supplies. You can see how supplies are debited at the time of purchase. On the debit side of the supplies account, you should also see a beginning balance, then all the purchases. If you take the beginning balance and add all the purchases, that would give you the supplies available to use during the accounting period. This is not an expense. The purchase of supplies is the purchase of an asset. The expense is calculated by figuring out how much supplies are used. The one way of doing that is, if we go to slide 18, we can take a physical inventory of how much in supplies is left at the end of the month, compare that to the supplies the company had available, and the difference would be the amount of the adjustment. So I hope you guys know what a physical inventory is. You've either taken a physical inventory or you've witnessed a physical inventory at one of your favorite stores. So the physical inventory determines the ending balance, and it involves counting, weighing, measuring the supplies that the company has left in the account at that point in time. The adjustment is actually how much of supplies were used in that time period. So similarly to all other prepaid expenses, we will debit supplies expense, which increases supplies, and we will credit the supplies account to show how much of supplies is used. Again, this is just an example that we will use later. Actually, at this point, I'm going to say that most of the problems that we work will be done on Wednesday, which will give you a little bit of time to read about adjusting journal entries and be able to understand the problems we work a little better. So earlier I mentioned the long-term assets are also prepaid expenses that we have to show how they're being used. The way we show usage of long-term assets, such as equipment, buildings, cars, in a year or in a month, is by allocating the cost of that asset over their useful lives. And we call that allocation depreciation. So let's look at how depreciation is calculated first. For the purposes of this chapter, we'll only look at straight line depreciation because it's super simple, it's super easy to calculate straight line depreciation. In order to calculate annual straight line depreciation, all we have to know is the acquisition cost of the asset, or the asset cost, if you look at the formula. We also need to know the salvage value, or the residual value of the asset, and divide that depreciable cost over the asset's useful life. So let's talk about useful life. Useful life is how long the company expects to use that asset. And useful life could be measured in number of years or number of months or units produced. So the useful life expires as a result of wear and tear, or because the asset no longer satisfies the requirement or the needs of the business to produce revenues. In this chapter, we will be looking at useful life expressed in months and years. And later in the semester, when we get to chapter 9, we'll learn how to use useful life expressed in units of product or units of activity. The salvage value, or the residual value of an asset, is what the company expects to get for the asset at the end of its useful life. We also call salvage value scrap value. So when we adjust for depreciation, remember we're adjusting for the usage of the asset, just like we did with supplies and the prepaid insurance. So we need to look at a few different things. We need to look at the original transaction. When did the company purchase the equipment or land or any other depreciable long-term asset? In this case, Fast Forward purchases equipment on December 1st for $26,000. We know from chapter 2 that at the time of purchase, equipment will go up or be debited $26,000, and the method of payment will be credited. At the end of the year or at the end of the month, the company has to prepare an adjusting entry for depreciation. So that's when we're going to look at the rest of the information. The equipment has an estimated useful life of 5 years, so we can calculate the annual depreciation pretty easily. We also know that the company expects that the equipment will be worth $8,000 a year at the end of the 5 years. This is the equipment's salvage value. Now it's December 31st. We need to prepare an adjusting journal entry for that. So I know because I'm specifically told that I'm looking at the period December 1st to December 31st. I know that depreciation will be monthly. So first step, we need to calculate the depreciable cost. We also call that net cost. So if we take the acquisition cost of the asset, which in this case is $26,000, and remove the salvage value, we know that the net cost or the depreciable cost of the asset is $18,000. So again, net cost is the amount to depreciate. The second step would be to take that depreciable cost or the net cost of the asset and divide it by 60 months. 60 months is 5 years times 12. Every month, the company will be depreciating $300 of the $26,000 minus $8,000 dollar depreciable cost of the asset. So again, before you guys can prepare an adjusting journal entry for depreciation, you have to be able to figure out what the depreciation actually should be. You also have to be careful and understand what is the time period you're asked to compute depreciation for. Is it for 1 month or is it for the whole year? If this was an annual depreciation, all you have to do is divide by 5 years instead of the 60 months or multiply the $300 times 12 months a year. When we're ready to adjust for depreciation, we will leave the equipment account alone. This account will not change until the time of retirement of the asset. Now look at this account. We'll be using an account called accumulated depreciation, which goes hand in hand in equipment. We'll be crediting this account. So this accumulated depreciation account is called a contra asset account. It's a contra asset account because it increases on the exactly opposite side of the asset account. It increases on the credit side. So again, this is an important term here. Accumulated depreciation is a contra asset account. The journal entry that we'll be preparing will be debiting a depreciation expense account, just like any expense account. It's debited to indicate an increase to that account, and we'll be crediting accumulated depreciation for that asset, in this case, equipment, to record the monthly depreciation. So as you're working problems, again, please be very mindful of the time period. On the balance sheet, we will show depreciation separately than the equipment in this case. The difference between the two numbers, equipment minus accumulated depreciation, is what we call the book value of that asset. So this is after 3 months of depreciation. They just wanted to see what that looks like. Equipment is no longer worth $26,000. It has been used $900, and the value of that equipment on the books has decreased. All right, so let's look at deferred revenues. Deferred revenues are unearned revenues, so they're liabilities. So when we're working with those accounts, you're working with a liability account, which decreases, and a revenue account, which increases. So revenues increase on the credit side, liabilities decrease on the debit side. So this is the last thing that we're going to do today. We'll look at the last example. I want you guys to spend some time between now and Wednesday with deferrals. Deferrals are the more challenging journal entry of the two adjustments. Of the 4 adjustments that we looked at today. So unearned revenues, we start with some kind of a prepayment by a client. When a client prepays for something in advance, that creates a liability, and the original journal entry which we studied and you should know from chapter 2 is a debit cash account and a credit to unearned consulting revenue. Remember what earned means. Earned means that the services are performed. when the client prepays, the services are not performed at all. This prepayment, though, creates a liability because the company makes a promise to provide the services in the future. So in this case, fast forward earns payment as time passes. So in this case, in December, they earned 5 days of service. And you can see the calculation here. When the services are earned, then everything needs to be adjusted. We need to decrease what the companies owe the client and increase consulting revenue accordingly. The journal entry for deferred revenue is debit unearned consulting revenue and credit unearned consulting revenue. So you can also use different accounts depending on what types of services and what types of are delivered and performed. Again, I want you guys to spend a little bit of time with the PowerPoints and the student summary and the book really, and understand what those deferrals are. Accruals, which is the second part of this chapter, are a lot easier. So when you come back on Wednesday, we will work the problems on Connect. Then we'll talk about accruals, and we'll finish Wednesday's lecture by working problems that involve the simpler of the adjustments called accruals. One of the things that you'll also notice is that this week your overview videos are due on Wednesday, just like they normally are, and your homework is due on Sunday, just like it normally is. But we won't be done with chapter 3 until Monday of next week. Monday is reserved for more practice problems, which will help you with the problems on the test. This is all I had for today. So if you guys have any questions, ask me now. And if you don't, have a wonderful day.